And we are live and we are back. Let's go. I'm Cory, your host, one half of the FinallyFit podcast, and I'm back like I never left with another installment of Wealth Wednesdays here on the FinallyFit podcast. We discuss health and wealth, finance and fitness, and everything in between. We want to make sure you save more and save less and keep making better your best. Yes. However, when my co-host Jordan went on paternity leave, we started these Wealth Wednesdays where I get straight to the financial information, no filler in between. And I know y'all see the topic of today's video. I have a handful of housing market, real estate type of articles that I need to get through. And today we're going to talk about, the state of the housing market. Is it getting worse? Obviously, it's getting worse in the sense interest rates keep going up. We're going to talk about how the housing market is impacting the economy. But I realized it only took me 61 episodes, more than that. But I pigeonholed myself. I love the alliteration with Wealth Wednesdays, but I've pigeonholed myself by, in theory, only being able to do these on Wednesday / releasing these on Wednesday because it's called Wealth Wednesday. If I want to record another episode and release it another day, right, it kind of defeats the purpose of calling it Wealth Wednesday. And if I don't drop it on Wednesday, and so as I was coming up here, like not even 5 minutes ago, I was like, I think I need to rebrand this. I don't know what it's going to be, but the articles are piling up on me, and thus, since they're piling up, they're going to become outdated. So I got to figure out how to not record more, but drop on different days. And then on top of that, we're going to start editing the clips so we can start releasing more frequently, get the content out in smaller chunks, pieces, things like that, which makes even more sense, right? I guess when I chop up a clip from a Wealth Wednesday, I don't have to call it a Wealth Wednesday clip, but you see the little predicament that I'm in. But hey, we're going to figure that out. Look at me, sloppy. I got the energy, but then I guess I'm messing up. Welcome to Wealth Wednesday, but got to figure that out. We're going to, what I see is, as y'all, I know y'all seen it, right? The thumbnail game is improving, and it is translating, right, into, some better numbers. Shout out to Anton Daniels, right? Y'all need to tap into people who can help you out. But the thumbnail game worked on it, and it has drastically impacted our numbers. So we're working on the progress. But what y'all need to do is y'all hit that like button, share, subscribe. All right, you're not hitting the like button, you're not subscribing. You might be sharing because the views is going up, but I need to see that like button and the subscribe button increase. Y'all don't have to, right? Shout out to the engagement. We get what we can get, but please, help more people see this from an algorithm standpoint. My information, as well as my coach Jordan information, can be found in the show notes. You can follow us on X/Twitter, right? Instagram, TikTok. I'm sideline_Cory. My coach Jordan is Stop Stalling J. And then FinallyFit.live is where you can go and sign up for the virtual training sessions at 5:30 a.m. Monday and Wednesday. All right, it's virtual, so no matter where you live at, you can hop on the call. And then you get access to the virtual drive. So even if you can't make that 5:30 a.m. Eastern Standard Time, by the way, you can still tap into the classes. All right. Now, it's about, we coming up on a time. This is why I need to record more. The student loan situation, right? We're about 35 days in, almost 45 days in to the student loans starting back up. And, it's starting to become a mess. Mohila, the big dog, one of the big complainers in the Supreme Court case about the forgiveness happening or not happening, which ended up not happening. They had a technical issue about restarting the loans or not restarting. And I told you I was going to be interesting to see how they just restart these loans after not having them active and short there this type of forbearance for over 3 years. Mohila had an issue. I read or saw somewhere that one person had a $108,000 payment due because they changed their term from, I think, 120 to 2, so from 120 months to 2 months. Like, a lot of crazy stuff. So Mahila went back into an administrative forbearance, but please know, so one of my clients told me this, the interest is still accruing. So that forbearance that we had during the panorama, that's gone. That's gone. Probably never to come again. That's what she said. All right, anyways, but the loans, for those of you who have Mohila, they are going into forbearance. However, it's come out that Mohila now is going to move people over to a new platform. So this is getting messy. All right, we're starting back up. Mohila, one of the biggest providers, if not maybe the biggest provider now that Navient's gone. Let me see. Who's the biggest provider? Is it Mohila? Sally Mae. Okay, I should have known that. All right, but yeah, so that's what's going on. But I wanted to talk about real quick something that I saw, and this article is pretty old. But when it comes, I wish I had this article before we had this whole debacle going through the student loan situation for the entire time that this podcast or YouTube channel has been up. But we're going to talk about how the United States federal government loves student loans. All right. The U.S., what does that say? What does that say, everyone? The U.S. government's biggest financial asset, student debt. Whole time. We all get into the real estate. Shout out to Michael Rainey. Is this Michael? Hold on. Is it Michael Rainey Kyrie? It is. Right. That's Michael Rainey Jr. But this one, my assumptions is not as that. Anyways, shout out to Tyreek. Shout out to Power. Anyways, student debt, the U.S. government's biggest. Wait, hold on. We hear a lot about government debt. What about government assets? All right, let's get into it real quick. The value, and again, this is September 28th, 2018. All right, so this is 4 years, 3 years. No, Jesus, 4 years, 3 years. This is 5 years old, a little over 5 years old now. So it's probably larger than these numbers. The value of federally backed student loans held by the U.S. government has risen by more than 1,000% since the last recession. Ms. Linsky says, and now tops 1.1 trillion. Are they considering the last recession 2008? I don't see, but that'd be my assumption. 2007, 2008, however you want to slice it. Let's say 10 years, they got 1,000% return. Jesus Christ. Yo, 1,000% return. That's not even video game numbers. That's just an act of Congress, pun intended. Oh my goodness. You need an act of Congress to get that level of return in 10 years. Federal government total financial assets. We got a 3.6% for U.S. official reserve assets. So 3.6 is what and then this is 2018, but what the U.S. has in reserves, 3.6%. Checkable deposits in currency, 11.1%. Other loans and advances, so non-student loans, 7.7%. Total mortgages, 4.6%. Student loans, it's not just the largest, it's freaking half. Oh, dang, it's freaking half. 40, there go my mouse, 45%. That is insane. Corporate equities 1.4, trade receivables 2.5, taxes receivables. So this is the taxes, all these taxes that we pay is only 16.4. And then total miscellaneous assets 7.6. My goodness, student loans being 45% in 2018 of the United States assets is insane. And y'all thought they was gonna forgive this? Now, if there was ever an article to sort of just put in front of people during this situation, be like, yeah, this probably not going to happen because of what this information shows right here. No way in hell gets forgiven. Not the large number y'all want. No way. Unless this has to change. 45%, essentially half. Yeah, no. You have no chance. Let me zoom in so everybody can see. I know y'all can see because I watch it every now and then on the big screen. But yeah, 45% not happening. They're not touching that. I can promise y'all. All right, let's see what the rest of the article is about. I think that's it. Sorry, I'm gonna show that real quick. But yeah, y'all, 45%. I don't know, in all honesty, what else to say besides you just got to pay off your student loans, necessities, debt payments, investments, lifestyle. Recommendation over here is to work the debt snowball. Even though in most cases your debt snowball, debt avalanche is going to be pretty similar, if not exactly the same, regardless if you rank them by interest rates. Attack the lowest balance so you can get that minimum payment back into your budget as fast as possible so you can build up that higher cash flow on a monthly basis as far as how much money you have to kick out, but continue to put that money towards your debt. Again, the snowball method or the avalanche method is still the same concept as far as rolling that minimum payment over and everything, putting extra towards that, whatever debt you're focusing on, to the next debt that you have lined up. But please, 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 please do what you can to knock these student loan payments out. It is only going to get messier and messier from here on in. And it's going to be interesting to see in the next, I would say this decade, right, the 2020s, is going to be an interesting one, right? We're almost halfway through it. We vote next year for possibly a new president. It is going to be interesting. We might vote in a new president. So we are going to vote, to put in a new president, but we might possibly get a new one. It is going to be interesting to see what happens as we get out of the 2020s, because we started out with a mother effing bang, did we not? Shout out to the panorama. But when it comes to these student loans, and with that information about it being 45% of the United States assets, according to 2018, it's just something you have to think about when it comes to, are they going to forgive this? Are they going to essentially, their biggest asset, risk the interest that it is generating for them? Because remember, the one thing with debt is a guaranteed return as far as, if you give out the loan, it's guaranteed as far as how much interest you're going to make, right? You set that interest rate. Imagine if when you invest into the stock market, you could set the interest rate that Apple, whatever, not investment advice, could pay you. That would be crazy. All right. So again, please lock in and focus to pay off your student loans. If you need help with that, please reach out to me. Again, sideline_Cory, or you can email me sideline@ventures24, and I can help you with your financial situation. But my goodness, this is insane. But now we're about to get into this article about the housing market. But before we get started, because no, I did not forget, don't sue me, sue your mama. This is for entertainment purposes only. Myself, no Jordan or fitness or financial professionals. Everything you hear on here is for entertainment purposes only, and you need to seek a professional and do your own research before taking any action. All right, here we go, y'all. We got to get into this housing market again, right? The housing market's not going away, and talk about what's really out here and going on in these. I guess they're not the streets because we're talking about houses, right? But what's going on in these real estate streets? One of the articles I want to do is, it was about, one of my friends sent it to me, how the real estate commission might be taking a hit for people who sell real estate, for real estate agents. Like, oh Lord, like, it's, y'all, if you don't realize how messy it's looking like it's about to get out here, look, stock futures are little change after S&P 500 registers longest win streak. Shout out to the S&P 500. All right, I need to start preparing for the end of the year wrap up video. All right, y'all. Less affordable, and we on Good Faithful CNBC. Less affordable homes don't just ruin American dreams; they're a threat to the economy. And I had to make sure that this wasn't a duplicate article for video I did, I think, 2 episodes ago. Because now stuff is starting to run together because I'm not getting no real sleep. Shout out to my son. So I had to make sure. I was like, did I already do this? All right, again, this was published August 25th of this year. Hey, speaking of my son, his birthday is August 26th. Anyways, Michael Farr and Keith B. Davis. All right, here we go. Being able to buy a home keeps getting harder and harder. True. Shout out to interest rates increasing. The National Association of Realtors, we're going to talk about NAR in that real estate article about the commission possibly getting cut back, said earlier this month that its housing affordability index fell during the second quarter to its lowest level on record. The reading came at 92.7 compared to 101.8 in the first quarter. It's also well below a 180.4 level reached in 2021. See, the panorama, we can't use panorama numbers. Like, shout out to 2021 at 180.4. You can't, those numbers have to get thrown away, the good and the bad. Those just need to be, if there was ever an asterisk, shout out to what's it, Spygate. If there was ever an asterisk, shout out to the steroid use era. Like, the panorama is the same thing as the steroid era in baseball. Now, everybody was using steroids, so it's fair play. And if you didn't juice up enough, that's on you. Everybody had options, had the opportunity to refinance or buy a home and get these low interest rates. But hey, we know that is not how things normally are out here, right? So when you see things talking about what happened during the panorama era, which we're still coming out of, 2023 is still going to be a pandemic year. 2024 will be the first pandemic year since 2019. You got to look at those numbers and be like, okay, whatever. This is all-time high since 2021. It is what it is. A reading of 100 signals that families earning the median income have the amount of money needed to buy a medium price home. A reading below points to insufficient median family income to buy a home. Was it a home now, or is it a medium price home? You see how they switch real quick? The data goes back to 1986, so a little under 40 years. So what are we saying here? They're saying it's at 92.7 right now. So it's gone down a little bit, but compared to what it was during 2021. But here's the thing too. People don't buy homes a lot. So this 180, let's just say whatever percentage they think people should be buying houses would rate at 180. These people bought houses. They're not going to buy, in theory, hopefully they're not going to buy a house in another 2 years. Right? I mean, at some point in time, we have to accept that some people are no longer making a purchase because they made the purchase when the level was at 180. All right. Incredibly, housing is now less affordable than it was prior to the Great Financial Crisis. What's the Great Financial Crisis? Is that 2008? Oh, y'all be slow, man. Is the Great Financial Crisis considered 2008? I dead ass don't know. Google it real quick. Yep, 2008, 2007, 2008 financial crisis. All right, because I wasn't sure. I'm like, just get different names, everything. No, it's the Great Recession, Great Financial Crisis. When a complete breakdown, in lending standards led to frenzied speculation, 33% peak to trough decline. All right, housing prices. All right, cool. What's this? Housing affordability index. Okay, sideways. So we got from this is the whole timeline. We talked about 1986 to now 2023. We've been on a run since 07. Housing affordability peaked in 2013, it looks like. So 10 years ago, we went on a downcline and then we peaked during the panorama. Okay, now we're on a significant downcline. Okay. All right. Now, here we go. Right. Fear mongering. Does this mean, shout out to the FUD, fear, uncertainty, doubt. Does this mean the last time we were this low, right, which is around 05, 06, leading into 07, 08, the Great Financial Crisis, as this article deems, are we heading for, in short, another 2007, 2008 type of financial crisis? No idea. Nobody can predict the future, especially when it comes to the economy. A recession will happen again because that's how the economy works. Eco, right? Like ecosystem, it will rain and real snow, and the sun will come back out, all that type of stuff. But when? Nah, I don't know. All right. It's not like the economy is not like the weather in the sense that it has seasons that you can predict, right? After fall goes winter, and after winter goes spring, after spring goes summer, and after summer, right, we go back to fall. So you can't guarantee these type of things. But at some point in time, the recession will come back. All right. The decline in housing affordability has obviously been highly influenced by the huge increase in mortgage interest rates. Now they're not at 7.2. Now I think they're at 8%. Let me just keep Googling average mortgage rate. Now I think we're at 8%. That's what I heard. Jesus. Yeah, Google saying 8.3 on a 30 year, 7.3. Look, shout out to the 15 year. 7.3 on the 15 year. Don't. Shout out to the ARM being at 8.1%. Don't get an adjustable rate mortgage, aka ARM, adjustable rate mortgage. Please do not get the ARM. Oh my goodness. Let that adjustable rate. Shout out to those of you who got an ARM during the panorama when the interest rates are really low, as if they can adjust any lower. You can't adjust past the lowest of all time. You can only adjust up, but hey, is what it is. All right. 7.2 according to data from Freddie Mac. That's compared to an average of 4% from the end of the Great Recession in 2009 until the end of 2021. All right. In fact, current mortgage rates are nearly triple. All right, level in 2021. Excuse me. Okay, the bottom out around 2.7. Not coincidentally, the first quarter 2021. Okay, this is just more data. Okay, housing prices are up 28% despite the massive increase in interest rates. Yes, because a lot of people were on the sidelines leading up, right, during the pandemic. I think we had maybe not an all-time savings rate, but one of the highest savings rates we had, at least in a long time, when the panorama happened. And so you got all that I was like pent up demand, but all that savings built up, and the people out here, they went and spent that money. On top of that, one thing Americans are going to do is go into debt. All right, so we're in a situation right now where the interest rates rising should be, I wouldn't say slowing down the housing markets, but in theory, should make it harder for people to get money, and thus you see hopefully prices maybe decrease, but over the long term, real estate goes up. So you're really trying to slow it down. But the pandemic made housing values increase faster than they should have in that time frame of what we'll just call 3 years now, from 2020 to 2023. It's only 4 years, but in that barely 5-year period. So housing prices are already too high, and then you got a situation where, due to the pandemic, and we had a shortage of resources, the new home market is still not back up to speed as far as pre-pandemic levels of them being able to build new construction. So now you just don't have enough homes, and essentially there are just not enough homes still in the market, which still gives sellers the position, or the better position as far as it being a seller's market, which is why you still see the home prices increasing. All right, so think about let's just say homes are overvalued. Not that they are, but quote unquote overvalued. And on top of that, people have extremely high interest rate. I wouldn't say they're high right now. They're a little bit higher. I mean, you want to see anywhere that 5 to 7% is probably, I guess, the average without looking it up of what mortgage interest rates normally are. Now we're over 7, in the 8 territory. So now they're getting a little bit higher. It's approaching, approaching double digits. But still, all right, we have all these different factors that are impacting the housing market from the pandemic, how that impacted just as far as interest rates and what happened with the housing market there. Then on top of that, from a building standpoint, we had the shortage across the whole planet as far as on all the different materials, and we're still dealing with that shortage, not just materials, workers as well, right? People did die, however you want to think about it, but people did pass away, so you can't just replace people instantly. That takes obviously the longest thing to do is to replace a human, right? It takes 30 years to replace a 30-year-old person. And so all these different factors are impacting the housing market. All right, median household income, which is currently growing roughly at the pre-COVID rate, has not grown nearly fast enough. Okay. Yes, income doesn't. What is income? Income don't even keep up with inflation. Median household income keeps up with the rate of itself. All right. And the consequence has been massive drop in housing affordability to new lows. I think one of the things too, when it comes to housing affordability, is there is probably significant FOMO. There's probably no data or articles, or there might be, but there are a lot of people who have FOMO about, dang, I could have bought a house during the pandemic and I didn't. And so now they want to go get their house. And you already have the general FOMO of everybody, just like everybody having a kid or everybody getting married. You have the FOMO of, dang, I need to get a house. Now you have it of, dang, I need to get a house. And crap, I could have had this super low interest rate, one of the lowest interest rates of all time for my mortgage. All of that coming into play as well. But what the housing market is doing, again, I think I said this on the housing episode 2 episodes ago, that should not impact your purchase. It might impact the house you get, but at the end of the day, your numbers are your numbers. It's just straight up math. You make X amount of dollars, your GTI is what it is. Then most people are going to recommend staying around a quarter, right? Shout out to 36% DTI, but no more than a quarter of what you take home. We're also going to do a 30 or a 15, right? If you want to put how much you want to put down, 3.5% up to 20% to avoid PMI, all those different type of things. At the end of the day, 25% of 10,000 is 2,500. So however you want to work the interest rate versus a 30 versus a 15 versus how much you put down, that's cool. But your mortgage can't be no more than $2,500 a month. Right. And so however much that house costs, right? The math, right? If you put more down, right, it can be $600,000 house, but if you put down 300,000, right, the math is likely to be more in your favor with interest rates being higher, but you can't still get the $600K house / mortgage and only put down, $100,000 versus $300,000 and think, you're still going to be able to have that mortgage payment work in your budget. The math is what it is before you even go and buy the house. And that's a lot of the time what people don't want to deal with, but that's FOMO, keeping up with the Joneses. Just don't buy a house you can't afford. And the house you can't afford isn't really a house. It's math that you can't afford, right, financially. I know all the arguments. This argument says. On Wednesday, entitled an article from the Wall Street Journal, How High a Rate Can Housing Take? By Justin Lahart, read on Wednesday. The National Association of Realtors reported that there were 980,000, almost a million existing single-family homes for sale last month. That was the fewest during the month of July, normally a time of year when a lot of homes are on the block. This goes back to 1982. Excuse me. Let's see. Where are we at? Yeah, we got a nice little chunk to go. Housing prices remain elevated. There's extreme, lack of supply. Again, I don't read these articles ahead of time. Lack of supply, inventories of homes for sale are very low because nobody wants to move. Again, why would you trade your interest rate? You got this. Some people got below 3. Some people have below 3%. Like it makes now, and again, now we're talking about people getting double the interest, not double the mortgage, double the interest rate. And then on top of that, most people, when they move up in house. It's not like people are moving down. Same thing with vehicles, right? People move up, right? Keeping up with the Joneses lifestyle inflation. The trend toward, again, work from home as well, right? We're in the same situation. Like, dang, I need an office now because I work from home, so I need somewhere to work. Some designated workspace area. You don't want to in the kitchen or in in the basement, you want something sort of sectioned off. So now, in short, you got a family of four, so you get to be 3-bedroom. Now you need, quote unquote, need a 4-bedroom, and ensure that you need that some designated office space. Right. Another factor causing homeowners to remain in place and therefore suppressing housing inventory. Work from home is causing. Okay. Oh yeah, I guess work from home. People don't have to move right somewhere to get for their job. It will take years to bring housing supply back in line with demand because new construction has been insufficient since the Great Financial Crisis. Oh, excuse me. They're saying new construction has been down since 2007, 2008. Lending standards have improved dramatically since before the GFC. Okay. Typical homeowner has much more equity. Yes, that home. I would let Jordan come on here and say how much equity he has. But when Jordan told how much equity he has in his home, what is it? Jordan has barely had his house for 2 years. So we started this in 2021. He got his house the same year we started the podcast. Jordan bought his house. Him and his wife bought his house in 2021. He hasn't even had his house for 30 months yet. I think he's right at 30 months. And when he told me how much equity he had, I said, bro. Also, too, Jordan got that 15-year, and 15-year usually has the lowest interest rate. 15 years usually always lower than a 30-year. But I was like, yeah, you just got, not that you got to sit on it, but like, it is what it is. And that's the one thing, too, we talk about an amortization schedule. People talk about building up equity, wealth, things like that. When you look at it on a 15-year, you build the equity significantly faster because more of your payment is going towards principal, or starts going towards the principal than interest versus a 30-year. 30-year, a lot of times, based on the average time that people stay in a house, which I think is around 10 years or so, a lot of times on a 30-year amortization schedule, most people aren't putting, let's say your minimum payment, your payment's $1,000. You're not putting $500 and a penny towards principal, so more money out of your payment going towards principal than interest. That usually takes over 10 years that build that level of equity. And now even longer now with these high interest rates, this is back in around probably anywhere from a 4 to 6 type of interest rate situation. I got the math somewhere on my computer, but we now are talking about having 7, 8, we're going towards maybe possibly 9, 10% interest on a 30-year. You pretty much got to pay that entire house off by the time you actually start putting money towards the principal aggressively. But most of the time on a 30-year, people actually aren't putting more money towards the principal than they are interest and other fees. You're talking about maintenance. You're actually losing money because of how long it takes for you to actually build that equity. All right, when it comes to making that mortgage payment. All right. Interest rates should start coming down next year. Everyone's saying interest rates should come down next year. And are we going to throw the interest rates coming down in the same boat with the recession? Eventually, the interest rates will come down, just like eventually a recession will happen. So I think we're starting to see now, because I've been seeing it more and more lately in the last month or so. People are saying, no, yeah, interest rates will come down next year. When it's like, what? Let me know when the Fed decides not to do a rate hike, but to decrease the rates. Is it Jerome Powell? If he comes out and says, yep, we're going to, lower rates, not keep them the same, but lower rates, next year, every time, different conversation. But right now, it's not looking like that's about to happen. All right. As it becomes clear that inflation is on a sustainable path lower to the right, the Fed's 2%, okay, and so on. All this is likely true, but still housing affordability is at an all-time right, is at a low. Since 1986, many prospective first-time buyers are at risk of getting locked out of the market forever if something doesn't change. Now, you can get into the market. You just might have to buy a house smaller than you want. When I say smaller, like size-wise and mortgage-wise, right? You might have been able to, quote-unquote, afford a $500,000 house when interest rates were around 3 to 4%. Now that they're around 8%, plus, you might have to get a $300,000 house. It is what it is, right? Go make more money. I mean, the math is what, shout out to Cam and Mace. It is what it is. The math, you can't fight the math on this. The interest rates are what they are. Your down payment is what it is. The mortgage, quote unquote, is what it is based on the down payment, and your income is what it is. And your DTI, your debt to income ratio, is what it is. I name it this. It is what it is. Like, at some point in time, it's not the market's fault. Like, you just have whatever money you got, and whatever money you got can only afford but so much. And especially with what the median household income is, the median is less than $100,000. And then we see what the median home price is. I don't know. Look, I say no more than 2 to 3 times, preferably on a 15-year fix or your gross. But if it's less than $100K, the median home price is around like 400K or past that. So at some point, or maybe that's the average, but at some point in time, it's like the math not mathing. Like people, how much or how many times and how long we're gonna keep saying people who don't have money should be able to go into debt? Like, why do people who don't have money, why should they be able to get things they can't afford? And then we complain when people don't have no money. And it's like, well, we keep incentivizing or putting a batter in people's backs saying, oh yeah, you can't afford this? No, go ahead and buy it anyway. Go into debt and struggle even more. That's what we do out here in the society. It is realistic to think everyone will remain in place indefinitely to keep their low mortgage rate. Hell, it might be. Let's be clear. If interest rates get above 10%, people are not going to move. They're going to have to, I would say, even, a lot of times people will move from a job standpoint, like, you outgrow your house, you have another kid, quote unquote, unexpectedly. But if interest rates get above 10%, you hard pressed to be like, yeah, let me get on my 3%, my 4%. Let me get 4% is, less than half of 10. That's 2.5 times. 2.5 times. Yeah, it's 2.5 times. If we get closer, if we get to 10% sometime next year, people who bought a house during the pandemic are not moving. The math you have to have in your favor, not the income, the math to have in your favor for it to make sense to move versus whatever you're trying to move forward is, essentially ensure building an addition or whatever onto your house. Not saying to do that, but from a math standpoint, it's going to get messy. What am I at? Just to keep the low interest rate, thereby preventing the flood of supply in the market, will political pressure on the Fed compel the central bank to cut rates more quickly, thereby improving affordability? All right. Let's be good. These banks credit unions, they can choose to offer low interest rates. I know they're not going to, they can just change it if they want to, right? They got to make that money. All right. These are all important questions, right? Yeah. Nobody has to answer this stuff. You can't predict the economy. Okay. Suspicion is that some combination of labor market softening, tighter bank lending standards, capital markets volatility, and rising mortgage rates will bring an end to the Feds. Okay. All these various things that can lead to the Fed lowering their interest rates, they're saying that could happen. Okay. Since as long as I can remember, Fed is always choosing the path of least pain. Maybe that's why we're the issue we're in now. Choose the path of most pain. Right, rip the Band-Aid off. Let's do what we got to do now. Shout out to bankruptcy. Some people just need to pay the piper. All right, and I don't think this time will be any different. Let's be clear. Shout out to Panorama. But there was ever a soft-ass financial period, it was then. People didn't have to make none of their payments. You had over 3 years for the student loan situation. You had, car insurance delaying your payments. Like, it was a lot that happened, especially in 2020. Late spring, early summer of 2020, we got our taxes pushed back. Like, it was crazy. It was a weak time as far as, the path of least resistance. When it comes to the 2020 and 2021, all the stops, the eviction forbearance, it was so much from a financial standpoint that people just were able to escape. If this means the Fed will implicitly adopt inflation target above 2%, well, the Fed say, hey, we're not shooting for 2%, we're shooting for 4%. And that's what we're trying to get to. All right, then I think that's what will happen. Okay. Not I, but as in the person who is, I'm quoting right here, ultimately believe the Fed's interest rate hikes to date will prove more than enough to slow the economy, reduce inflation to target, and potentially induce a recession. So we're trying to induce. All right, shout out to labor giving birth. We're trying to induce a recession. Let's look at the definition of induce, so we're clear here. Succeed in persuading or influencing someone to do something, bring about, to give rise to. So the Fed is trying, from this person's point of view, give rise to recession. So the Fed's trying to make a recession happen, right? We need things to recede. We need stuff to slow down. We're out of whack here. The long and variable lag has proven longer than expected, in no small part because homeowners wisely locked in super low mortgage rates, all-time low, when they had a chance. But fixed rate mortgages won't be enough to nullify the impact of 525 basis points of interest rate hikes in a historically short period of time. Okay, 5.1 basis, not one. I think 100 basis point is one interest rate. Let me see. I don't feel like looking at the basis point now because I need to wrap up. Hey, the time went back, but even though it's 6:30, it's so dark out. My brain still thinks like, it's time to go to sleep. All right, given its importance to the, all right, I'm gonna look up the base point answer at the very end of the article. Given its importance to the wider economy and robust housing market, will likely be a precondition to achieving a relatively seamless transition to long-term economic expansion. The housing affordability crunch is and looks to continue to be a risk factor that could not only hold back the economy's growth potential, but also cause a financial crisis if left unchecked. So add another ball to the Fed's juggling act. Yeah, let's be clear. Yeah, okay, yeah. 100 basis points is 1%. That's what I thought. Okay, cool. So that's 5.25%. And again, this was by Michael Farr and Keith B. Davis. Shout out to my brother-in-law. His name is Keith. Less affordable homes don't just ruin American dreams. They're a threat to the economy. For those who don't know, a lot of, say, people, but the entities that are buying houses right now that have entered the market are institutional investors. So we got businesses in short out here, not people, families, but businesses out here buying up houses and thus renting them out. I wouldn't say we need a recession. It's time for one in the sense of, again, from an economic standpoint, it will happen again. But one of the main issues is that, and overall America, right? I mean, how much that America has, but people not realizing that they just shouldn't buy things that they can't afford. And the interest rates are what they are. If you had the top opportunity, like myself, right? I'm a perfect example, had the opportunity financially, right? Was in the position to buy a home when interest rates were crazy low. I didn't do that. Now I'm in the situation I'm in, right? And housing decisions got to change. It is what it is, right? But I'm not out here complaining, right? Willing to put in the work to quote unquote offset the interest rate hike. That's what it does with the mortgage payment. But it also has allowed me to have time along with my wife. But clearly, like, what do we really want? Like, I mean, how much house do we want? Because now it's like, even we still quote unquote afford the same house as far as how much the house will cost. Do we want a house that size? All these different type of things. And a lot of times I think people don't embrace the fact of something being delayed and having more time to think about it and putting themselves in a better position. They always, again, have the FOMO and think they missed out on something. When really all you need to do is focus on what you want, control what you can control, and achieve what you plan on achieving in life. And if the mortgage rates are too high for you right now, unless you have to continue to rent, tough luck. Like, you can't make them go any lower. All right. Jerome Powell, head of the Fed, I know it's not an elected position, right? But I don't know if the president does. Yeah, okay. The president appoints the head of the Fed. So you can vote in the person who is going to appoint the person in charge of the Fed, but you cannot control who is the head of the Fed directly. It's going to be what it's going to be. I'm going to say my prediction, but I do not see interest rates decreasing next year. If there's some people are saying they're going to be, I've seen when we get to the end of 2024, 6%, I'd be damned. I'd be surprised if interest rates are around 6% at the, a year from now. Now, that'd be a good thing. I would not be mad at it, but things aren't looking like they're going that way. All right. Again, next year is election year. Today is voting day because today is Tuesday the 7th, first Tuesday in November. Next year is election year. I mean, if you haven't been looking, but we got we as the Democrats, we as in the American people, have Biden as an incumbent. Not we as in the Democrats. I'm not Democrat, but we got who is the Republican candidate? Like Trump has what, almost like 100 charges. I can forget how many. They just keep adding up how many charges, but it's going to be interesting. Usually, this is the first election where, at least in my lifetime, where it's like, I don't know who are the options this year? Like, even with an incumbent, it's like, is that what we're dealing with? For Bush won, Bush's first two, it was Al Gore and then John Kerry, and then Obama was clear cut, but Obama was clear cut, and then obviously you get into Trump, and then Biden. But it's like, I guess. So it's going to be interesting to see all these things unfold because obviously these things will impact the market. That's the housing market. All right. And then obviously got what's going on overseas. All right. But that's it, y'all. Locked and loaded. End of the episode. Make sure you hit that like button. Share and subscribe. Shout out to the YouTube algorithm. Make sure you leave those rating reviews on the podcast platforms as well. All right, slow down, but I'm intentionally talking fast on that. My information, as well as my co-host Jordan information, can be found in the show notes. Again, sideline_Cory, and Jordan is Stop Stalling J. Jordan's business page is FinallyFit.live. That's where you can go to sign up for the 5:30 a.m. Monday and Wednesday, 5:30 a.m. Eastern Standard Time, Monday and Wednesday virtual training sessions. You can reach out to me. Again, my contact information for any financial coaching, training sessions, 1 hour. All right. By the way, let me say this now as I wrap up. Got some new clients. One of my clients is like, you need to raise your prices. I was like, what? See, the benefit is once you get with me, you get locked into a price. I was like, I need to raise my prices. They're like, yeah, this is too low. I was like, okay. So I had to reach out to my assistant, aka ChatGPT. And ChatGPT was like, you might need to charge 6 times. I was like, 6 times? I was like, so I haven't made a decision just yet because I haven't had time to really sit down and think about it. But highly likely, like 60-40, leaning towards increasing, really changing my price, not increasing them, changing, right? Getting rid of something and just only offering something I'm currently offering. But I'll update everybody once that happens. But hey, the demand is increasing, more results are being had. You've been doing it longer, yada yada. And so, I mean, at this point, I'm a decade in. If we add up my banking, my teller experience with how long I've been doing the financial coaching on the side, I am at 9 years. Next year will be 10 years. So, I mean, at some point in time, right? 6 + 3 is 9. Next year will be 10. I guess I could increase the pricing, but hey, it is what it is. But that'll be next year. So if you want to get locked in at the lower rate, you have to do it before next year gets started. All right. But again, remember, if you have any questions, comments, concerns, please let Jordan and myself know. Please leave a comment. God, that's what I gotta start saying. Leave a comment and let us know what you think about the video. Again, hit that like button and hit that subscribe button. We appreciate the feedback. We see the numbers going up, but we would like more general engagement as far as the comments, so we know what y'all want to listen to. Because y'all just leaving me to my own devices right now. All right. And based off of what I see the numbers do, that's what I do. I have all these articles queued up, based off of what goes on from a pop culture standpoint as well, right? You got the DJ Envy thing. Is DJ Envy going to jail? Is Caesar going to jail? Right? All these different type of things. We'll talk about that. But if y'all want to hear something, just let me know and I'll queue it up and get it out for y'all. And again, like I said, gonna work on Wealth Wednesday. Probably won't go away, but I gotta find something else to name it so I can just drop on any day. Not name it as in Wealth Wednesday, but figure out something else. Maybe Wealth Wednesday will go away, but I gotta find something else. See, what is Sideline? Sideline Sunday's already taken. I was gonna do Financial Fridays, but again, that's on Fridays, right? Savvy. I mean, I gotta figure out something else to name this so that I can drop whenever I want to. Not have to always wait till Wednesday. But all right, y'all. Locked and loaded. End of the episode. Remember to save more and say less. Keep making better your best. And I'll catch y'all in the next one. Back in the video.